Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Welcome to Ask Rob and Rob. Thank you for joining us for another couple of questions from our wonderful listeners. Josh and Lee have stepped forward with questions this week, so we will get to those as soon as we've reminded you how you can get your own question answered.
It remains super simple. The easiest way to get your question in is go to propertyhub.net/ask, whether that's on your phone, on your desktop or your tablet. Go there, press the button, leave a message. If you mess it up, leave another one, and hopefully you can appear on the pod just like Josh is about to.
Hi, Rob and Rob. I'm Josh from Greater Manchester. Huge fan of yours, and I've been listening to the podcast now for a good few years. I've managed to build up a portfolio of 3 properties over the last 2 years. They've all done really well, with the prices rising by around 20 to 30% each. I'm now looking into remortgaging and releasing some equity. By doing this, I'll be able to release around 60,000 after the fees, but it will reduce my monthly cash flow by about 25% until I do purchase another property, which will then put the cash flow back to a similar level where I already am now. With this, does it make sense to take on more debt to maintain the same cash flow as I currently have? I understand I'll then have another property which will potentially achieve more capital growth, but I'll just after your advice. Thanks, keep up the great work. Cheers.
Josh, really good question. Before I give you an answer, I'd like you to rerun your numbers. I'm not saying that you've got it wrong, although obviously I'm suspicious, because it will depend on where you're investing in and the type of mortgage that you're going for. But if you're using an interest-only mortgage, which you should be in most circumstances when you're doing buy-to-let, and you're investing in, just say, an average area, normally you'd expect to be a little better off at least when you recycle that money and put it into something else. However, if we assume that that's not the case and what you've stated is true, then should you go ahead? Well, it's going to come down to your strategy and what you want. If you're in it for the short or medium term, I would say no. And the reason I'd say no is because you've got an extra property, and with extra property comes the chances of extra hassle and extra problems and extra challenges, and cash flow-wise, you're no better off. However, if you're in it for the long term, if it was me, I'd give it serious consideration, because the real wealth in property is made through capital growth. And because you've leveraged, you're really maximising that. Over the long term, the debt that you have on those properties will be devalued by inflation. We all know about inflation. That's very on trend at the moment. So the value of those mortgages will be eroded over the long term, which is great if you're carrying debt, which property investors do. And the asset values tend to rise as well. So you get that double whammy. So if you can extend your portfolio out further, you're taking advantage of both. If there are any short-term dips in the market, there may be people listening to this and go, well, what happens if the market doesn't go up or there's a dip? Well, in the short or medium term, of course, that's possible at any point. But over the long term, we know that property performs. So that's why I say if you're in it for the long term, I would push on. And if it was me, I'd be happy to do that. But if you've got a different time horizon and it's more of a short to medium term point of view, I'd possibly reconsider.
Okay, let's have our next question now from Lee.
Hey, Rob and Rob. Been great to listen to your podcast for some time now. And I might be looking to have an investment, hopefully in a year's time, or my first house for a buy-to-let. But I want to ask, what do you feel is going to happen for the next few years? Do you feel there'll be a crash coming up in your predictions, even though I know you don't really do predictions? And what do you think would be the best course of action when I finally have a bit of money to play around with? Because I don't really want to buy in the peak of house price rises. So any thoughts on this is great. And if you feel I should wait for a few years and just continue saving money, that would be great to have your take on this. All the best, Lee.
Lee, thank you for the question. You said that we don't do predictions. We actually do predictions. We record a predictions episode every January, and then we hold ourselves to account, go back and listen to those predictions and see how we did in December. This year's might not be that pleasant. But the reason for doing that isn't so you can hear what we think is going to happen and then go out and invest accordingly. It's to give you an opinion that you can take into account. Because we don't know. Nobody knows. It's impossible to predict what's coming up. So over the years, because we're in the market all the time, we're close to what's going on, we think about it a lot, our predictions have been more right than wrong, I would say. But you're always investing in conditions of uncertainty. In terms of what's coming up over the next few years, go back and listen to episode 475. That's from April this year. And believe it or not, at the moment that still applies, despite everything that has changed since April. But I actually think that there's a more important message than telling you what we think, which is getting to grips with this point about uncertainty. We put out a YouTube video recently called Experienced Investors Avoid This Mistake. We'll try and get that link to in the show notes so you can go and check it out. But it's making this point about how everyone is very fixated on what is going to happen over the next couple of years. And obviously, it's a logical thing to think about because, as you put it yourself, you don't want to be buying just before a crash. No one wants to be buying just before a crash. But the problem is no one knows with any degree of precision when a crash is going to be. So you see people staying out of the market for years and years and years and years because they think, oh, surely a crash is just around the corner or something's coming up. This sounds scary. There's going to be a crash. And as a result, they never get around to investing at all. And in the video, I lay out an example of exactly what that looks like and how much money you could have lost by doing that over recent years. But investing is inherently uncertain. If you've been invested in the stock market over recent months, you've probably lost 10% or so. The value of your pension's probably gone down. These things happen. Does that mean that you should never invest at all? No, it means that as far as you possibly can, you should have a long time horizon. And I know that that's not everyone's situation where they're able to have a long time horizon, but ideally you want to. Because if you're investing with an aim to do really, really well over the next 3 years, so you can make some big change in your life as a result, well, the market can absolutely hammer you and leave you worse off than you were at the start. But if you're investing for 20 years, then it's ridiculously unlikely that it will end up worse as a result of investing, whatever the point you invest. So I'm not saying don't worry about what property prices are. I'm not saying don't think about the market. I'm just saying listen to our opinion, listen to other people's opinions, then come to your own view and try to keep that long-term focus and not get emotional about what might happen in the short term if you can, because that's what will give you the confidence to take action at the time when it makes sense for you.
So there we are, 2 questions in, 2 answers done. We finished our to-do list, but make sure you finish your property podcast to-do list and join us on Thursday for another episode. But until then, take care, have fun. Bye-bye.
Bye-bye.